What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked number one on Wall Street in the 2024 All-America Institutional Research Survey. Over the past few years, there has been a lot of narrative volatility around whether the economy is headed for a soft landing or a recession. Instead of focusing on that ongoing debate, in today's show, we're going to revisit a topic that we've talked a lot about in recent years and that we believe is far more relevant and actionable today: the idea of macro and micro bifurcation.
Hello, Michael. I'm so glad we're here today talking about bifurcation and the dispersion we've seen between economic data and company earnings data. I think it's so important. Over the last couple of years, have seen continuing changing narratives, macro narratives, market narratives. But really, and I can't remember in our time where it was so straightforward what was the defining characteristic in your portfolio between stocks that are outperforming and underperforming. It is very simply come down to, are these companies the kind of companies who are able to grow earnings in this backdrop of kind of changing macro tailwinds and bifurcation between kind of haves and have-nots, and those whose earnings aren't growing or maybe even shrinking? It's so incredible. I've never seen it so clear as an attribute of understanding performance. Can you talk a little bit about what's driving this? How do we get here?
Sure. I think we can wind the clock way back to talk about how we got here, but let's start actually talking about the 2000s, after the tech bubble popping and the beginning of the global recovery in late 2002, early 2003, because we're talking about bifurcation today. That period, I would say, is the complete opposite of bifurcation. That was almost 4 or 5 years where the global economy was the strongest and broadest probably in history. And I have a bunch of fun stats we could talk about. We know the emerging economies were booming, led by China. We know the US economy was booming because we were blowing a housing bubble. We know consumers were borrowing. And so you had a great period, several years of really deep value leadership, and risk was really something that helped your portfolio, taking on more risk. Obviously, that was true up until 2007 when things started unraveling. And so that led to the GFC and zero interest rates. And as a result of ZIRP, you also had a period of time, though with much weaker growth and certainly much lower inflation, you still had a fairly broad, I would say more in the US economy, broad backdrop in terms of fundamentals and macroeconomic improvement and breadth. And again, a lot of that was attributed to the fact that interest rates fell all the way to zero, so interest expense became not an issue. And a lot of companies that wouldn't have survived in a normal interest rate or a normal inflation environment were able to do okay. And then we had COVID, and all of that, of course, changed. We pushed interest rates back to more normal levels after almost decade and a half of zero rates. And we saw the first inflation shock in the United States in 40 years. And so that's given us this backdrop where you're seeing just this persistent bifurcation in fundamentals, both on the macroeconomic side and within the market on the microeconomic or company fundamentals side. So I think really what we've seen since 2022, when all of that radically shifted, because we knew now in 2021, all that stimulus money broadly helped the economy, but that didn't sustain itself. And so what we're seeing now is that we're definitely seeing plenty of companies and consumers and areas of the economy that are able to do very well in this macroeconomic environment of normalized interest rates and normalized inflation. But at the same time, you're seeing those that were hanging on after GFC from zero interest rates and low inflation really struggle. And there's a lot of ways you can break it down by large and small cap, or by middle income and higher consumers versus low income consumers, et cetera. And I think I'm excited to talk about this today because I think this is going to be an issue, unfortunately, that for some time is going to persist.
You bring up the common way that people are used to hearing this. It's that large versus small or high end versus low end consumer. And I know a lot of people listening, especially with what's happening so far year to date, say, well, look at the Mag 7, they're down. But this story is much broader than that. It has been a monotonic relationship, even within indices. You could look at the mega cap versus the 500. You could look at the 500 to the 600 from investor perspective. And you've just, for years now, just seen this widening spread.
Yeah. And even within the small cap index, you can see how the larger companies continue to this day we're recording this on March 21st on Friday. To this day, we're still seeing the larger companies, and it's got nothing to do with size specifically. It just has to do with that companies that are larger relatively tend to have better fundamentals, better access to capital, greater ability to pass along price, economies of scale, et cetera. So that has really continued in 2025, a trend that we began to see really open up, or where the microeconomics began to bifurcate really in 2022. And you could also look at the macro backdrop, and you're seeing something similar across economic sectors. So for example, housing has certainly been one of the weaker parts of the US economy, whereas you could say, I guess, AI investment, or even more broadly, services has been the stronger part of the US economy. In contrast, manufacturing has been very weak. So these macroeconomic bifurcations, I think, are reflecting in some part the same issues and headwinds, and they're struggling for the same reasons that some of the issues for lower end consumers and smaller businesses are struggling as well.
Now, the housing thing that you mentioned is very interesting, because that's been one of the things you've pointed out over the last couple of years, is that's the lack of fuel. Housing may be a small part of equity markets, but it's such a huge multiplier effect for the overall economy and markets.
Yeah, and that goes to the HOPE framework that we use. And the reason it starts with H, every cycle that we've studied, the beginning of a broad-based US reacceleration, whether it's coming out of a recession or the beginning of a soft landing, every single one of them historically has started with a rebound in leading indicators of housing, like building permits, mortgage applications, housing starts. And that's usually the case because, of course, every cycle, every reacceleration was preceded by some form of easing and lower interest rates. And the sectors that are most sensitive to that are those that typically begin to turn up. So that's why in an economic downturn or recession, investors and economists are always watching the housing sector, which is a subset of what people often refer to as early cyclical stocks or sectors, begin to show signs of green shoots. So that even in 2009, I think the housing stocks bottomed in the fourth quarter. I'm not looking at the chart now, but I'm pretty sure it was an absolute basis. They may have bottomed even before that slightly on a relative basis. But that again, even happened in that crisis. So right now, we've obviously had a couple of years now where investors continue to move back and forth on the view on how the economy is going to land. Is it going to be a soft landing? Is it going to be a hard landing? Is there no landing? So far, it's been no landing, or I would say we haven't landed yet, because at least in my framework, we haven't seen that housing data that has consistently marked the beginning of a true economic reacceleration in the US, which provides for a true broadening of fundamentals, where you go from maybe being very bifurcated at the end of a downturn to being more synchronized. That just hasn't happened. And if anything, a lot of the housing data in 2025, especially the lagging data like inventories and home prices even in parts of the country, have certainly started to get worse. Today, we got news from Lennar, and they were talking about how traffic is seasonally very weak at a time where they would expect to see more of a pickup there. The home building stocks continue to struggle, of course, with mortgage rates that are still high, home prices that are still high. And that's not a good sign. You want to see green shoots there to get more optimistic about breadth in the economy improving. And as of today, certainly with all the tariff issues, that's not happening right now.
Yeah, you're right about when you mentioned housing in the fourth quarter. That's also when beta bottomed and you started to see risk begin to work. So I think you're pretty right about the dates there.
You're speaking to, just to be clear, 2008.
Yes.
Fourth quarter of 2008. Yeah. Just for our listeners, because I thought you were talking about the fourth quarter of last year. And I'm like, what is Stephen talking about?
No, 2008. I was harkening back to your other example. But yeah, housing is where your hope cycle begins. So that's not what we're seeing today.
I think it's interesting because we certainly had the view in 23 up until the back part of the year that we were at risk of going to recession. And, what I guess gave me continued confidence in that view was that we were seeing all of these kind of warning signs from parts of the economy that were classic leading indicators heading into recession. However, what it clearly turned out to be was that we were in more of a K-shaped economy, and those issues at the bottom of that weak part of the K just never got big enough to cause a broader downturn. And the healthier parts of the economy were doing quite well. Plus, obviously, we had a tremendous amount of fiscal spending, as everyone knows all too well right now.
So from a portfolio standpoint, talking about equity markets and pulling it back to that for a second, one of the big places that the have-nots have been represented is in the Russell 2000. You've seen that index, whether you're talking the overall index in futures or IWM, has basically been a widowmaker. It has been one of these things that people have continually called for, time to buy small, time to buy this. And that index has continued to move a lot but go nowhere. Why is that such a representation of this bifurcation in economic data and earnings? Why is that where, you're seeing that weak link?
Yeah, I was looking at actually a chart today of the XRT, it's the S&P Retail Select Index. And it actually looks just like the Russell 2000 if you look back the last 3 years. And of course, that is another area in our economy, again, to the macro level, where some retailers have done really well in the last couple of years, and some have done terrible. And in that index, obviously, there's a lot of names that are just trading with a lot of volatility because, again, the profits haven't gone anywhere in a couple of years. You saw a downturn in profits in 2022. Things picked up a little bit in 23, and then there's just generally been sideways. That was somewhat similar to the Russell 2000, less so the mid-cap area of the U.S. markets, where earnings broadly were strong up until roughly the middle of 2022, or at least earnings expectations. And then they just fell out of bed for small caps and have yet to get anywhere, basically haven't gone up since then. And all the while, of course, in the large cap space led by the Mag 7, that carried the story there. The Russell, why is it under so much pain right now? You were looking at this, Stephen, a couple of days ago. How many stocks in the Russell 2000 still are not profitable?
42% of the Russell 2000 stocks have negative trailing net income.
Yeah, so that's a big number. And part of that, there's a lot of biotechs in there, so we're not going to fault it for that, that are unprofitable. But there's plenty of other companies that, should be profitable. They're not just this pure long-term investment company like a biotech, I guess. The issue within the Russell is that going back to the debate around, is the economy rate sensitive or not? And I think a lot of people, maybe still to today, believe the economy is not rate sensitive. But maybe that's the wrong question, because clearly there are parts of the economy that are extremely rate sensitive. And on balance, that helps explain those parts of the economy that are doing poorly today and for the last few years, why they're doing poorly. So smaller businesses in private mom and pop businesses where you see data from the NFIB really have reflected this well. And smaller businesses are extremely rate sensitive. And so that continues to be a big headwind in that area. In addition to that, when you're looking at the monthly NFIB survey, they also indicate or continue to indicate that labor costs are a problem. That's a tight labor market that we've had, though it's not as tight as it was a couple of years ago. They're still struggling from that. And ultimately, they're also concerned about weakness in sales. So when you think about sales weakness plus high interest expense plus high labor costs, all of that comes to a backdrop where your margins are just going to continue to be under pressure. And that's what you continue to see within the small cap space. And at the same time, I think actually interest coverage ratios, so that's basically how much cash flow a company is earning relative to their interest expense. So basically, can you pay your debt service? For small caps is outside of COVID at the lowest levels in history today, and history going back to, let's say, 1995. Whereas large caps, so that's at that ratio is about 2 interest coverages in the index. Large caps are sitting around, 8 or 9.
Wow.
It's like they're not even playing the same game. So plenty of interest coverage there, which I think is part of the reason why large caps are more highly valued than small caps. And you see the same thing across other metrics, profitability, margins. And again, it's not that just one is high and one is low, is that they've gone different directions for now 3 years. And it did begin even before the Mag 7 story kicked in early 2023. And so I think it's, again, Mag 7 has taken all the attention, but it's really more of just an economies of scale situation.
Yeah, the Mag 7 gets a lot of attention, but if you look within sectors and you're stepping away from the AI story, the larger sectors have outperformed their Russell 2000 sector counterparts or their S&P 600 sector counterpart because their earnings have been much better. It's that scale idea and the fundamentals, they've just been less affected by this macro bifurcation that we've been talking about.
Yeah, and even if you take out the Mag 7 and let's look at big cap earnings versus small cap earnings, so moving down. And mid-cap earnings bottomed out around early 2023. They've gone up a little bit in the last couple of years, certainly not as much as large caps, but they've gone up. All the while, small cap earnings have not. So if we completely ignore all US large caps and just look at the S&P 400, the current correlation between earnings in mid and small caps has, over the last couple of years, gone from, pretty much 100% for all intents and purposes in 2021, down to literally zero in the last 12 months, and has been falling pretty much for the last 2.5 years. So that is a bifurcation. It's that one is going up, the other one's not really going anywhere. So there is no correlation anymore. It's not necessarily inverse, but that correlation's gone down. And so when we think about the markets over the last couple of years, I think a lot of people think the S&P outperformed, not just because of Mag 7, but because of PE expansion. And the interesting thing is that when you look at the large cap index or the mid cap index and the small cap index, they all saw roughly the same amount of PE percentage decline in 2022. And then subsequently all saw the same PE percentage increase in 23 and into 2024. So if we actually measure where the PEs were at the end of 21 and to be basically at the end of 24, they were all roughly at the same spots. So when you look at over that time, PEs actually really didn't contribute anything to returns. It was really just a difference in where your earnings have gone. And so all of the large cap outperformance in the S&P 500 was due to just better earnings, which goes back to why the Russell 2000 hasn't gone anywhere. And I think, to me, doesn't have a tremendous amount of upside from here, at least from an earnings perspective. We could get some tariff relief down the road. We can get excited about tax cuts, or maybe the Fed can cut. And that often leads to credit spreads tightening, risk appetites growing, and PE expansion amongst different groups. But that doesn't necessarily translate into better earnings. And so the question is, when is this bifurcation going to end? And what is going to be the reason it ends? And I think, again, a lot of this is just due to the fact that while everyone is talking about the transition to AI ahead, and certainly that could be a solution down the road, I don't think it is in 2025. The transition that's really happening or happened that is causing this is the transition away from ZIRP, from zero interest rates, and low inflation and low prices. We can't forget we had 15 years of really low interest rates, and the likelihood of just going to this higher level of interest rate and everyone's going to benefit the same is obviously not happening. And whether either interest rates need to come down sharply, and when I say sharply, there's really only one way that happens. Sharply is a recession, or they need to come down steadily over time, and a combination of lower interest rates and time going by that helps to start to heal this bifurcation that we're seeing.
Yeah, lower rates would help out housing and kind of kickstart the whole economy. To circle back for a second, that comment you made about multiples, I think is so interesting. And I also think would surprise a lot of people, because a lot of the stories you've heard about the attractiveness of smaller cap stocks has been based on their multiples. And to hear that from a percentage standpoint, large and small cap multiples have gone up the exact same amount, I think would shock a lot of investors, because a lot of people think about the absolute number and not that change. And that absolute numbers are driven a lot, we've talked about it on the podcast before, by index composition. I think that's one that people really would be shocked by.
Yeah, really, there's two opportunities typically for risk or small caps to outperform. One, the most reliable and consistent one, and often the reason these smaller companies or higher risk, more cyclical parts of the economy are outperforming, is because their earnings are outperforming. And Clearly, that has not been the case over the last few years. What often comes along with a broader based improvement in earnings. So if you think about it start from a macro perspective, how does that begin? You get some easing in the economy, the Fed's cutting, and then you start to see housing rebound, and then manufacturing activity starts to rebound thereafter. And so you start getting macro breadth really kicking in. That is what happened in 2012. That is what happened in 2009, 2003, even happened in 2019 up until we had COVID. So you start to get some improvement in macro breadth, and that creates a broad rising tide that lifts all earnings boats. What often coincides with that is also a sharp tightening of credit spreads. So you get this combination of broader, stronger earnings expectations coupled with a big increase in risk appetite as credit spreads tighten, essentially as risk premiums go down, which in the equity market, the translation to that is higher PEs. So what we did see in 23 and 24 is that PEs, of course, did go up. Credit spreads, of course, did tighten. And Russell 2000 stocks did go up off their lows, but they did not perform because that return of risk appetite really wasn't due to a return of broad earnings. It was really due to the end of rising inflation pressures. That was really one of the first periods that I can think of where you had credit spreads tighten as much as they did, and smaller cap companies and the real high beta trade did not outperform. And so going forward now, we're sitting here today with credit spreads that are up a little bit because of tariff fear, but still extremely low at a time where obviously investors are starting to worry about stagflation and inflation and uncertainty. So all those phrases I just said, I don't see how they're not increasing the bifurcation in this economy, because those companies that are going to be most negatively affected by uncertainty, higher prices, and certainly falling stock prices, and potentially job losses if things get worse enough for long enough, are going to be those smaller businesses and middle to lower end consumers. So that just further bifurcates it. Maybe then it also brings about lower interest rates, and then you can begin the healing process down the road. But I don't think we want a recession to heal the other problem, but that's what it might take in the near term.
So you just mentioned one of the most topical news pieces we've seen this month, tariffs. So your view is that tariffs just exasperate the situation, and it continues to be a backdrop that favors large over the smaller companies that don't have that fundamental cushion, that margin of safety in their margins, their interest coverage, as costs potentially rise?
Yeah, it's certainly something that has been more systemic in equities in recent weeks. And we're certainly seeing a broad-based decline in soft data, whether it's manufacturing activity or consumers' expectations of where interest rates are going higher and inflation higher, where stock prices are going lower, where employment's going lower. So I just can't imagine that's a better backdrop for really anybody, but it's going to be most difficult for those that were already struggling to begin with in this backdrop.
I think it's a great way to say it. If you were already struggling, this doesn't help.
No.
So this is interesting. I'm so glad we were talking about this, because I know it's a term that's been thrown around so much over the last year. We, in our written work, have used the word thousands of times, but it's been such a defining characteristic and such a straightforward way to understand what's going on in individual equities.
I think one of the lessons that I learned from this backdrop, because again, this is by far, in the context of bifurcation, probably the longest we've seen, certainly I've seen in my 20-year career, and I'm sure you have too, because going back to 2000, the last 25 years, we've seen nothing like this. And so the one thing I certainly have learned in the last couple of years is to not necessarily extrapolate really negative data onto the whole economy, or not really extrapolate really strong data onto the entire economy or stock market. That weak data may be a function of weak segments of the market and economies, and strong may be strong. And that's okay. It's actually probably a better backdrop for active stock pickers, rather than equities and the whole economy being really correlated to the upside or the downside. And again, today we saw Capital One and I think Discover, they had some new data on charge-offs. I think Capital One was at about a 6 and change %, so a 13-year high in their charge-offs. Discover was at an 11-year high. And so those are all very classic pre-recessionary signs, seeing delinquency rates go up. But perhaps, again, maybe it takes just a really deeper downturn in this economy to really take the whole thing down. And that's something that's very different. And we just got to take some of the history with a grain of salt because we are in a very bifurcated backdrop. Again, I think largely because of the hangover from ZIRP. And there's really not a period in history that we can make a comparison to.
An unsynchronized economy. So do you have any kind of investment takeaways, thoughts on the road ahead? Where would you want to be positioned? What are you recommending?
Just in general, we've been big fans of embracing this quality story, and whether that means higher interest coverage, higher profitability, more stable earnings. Again, if you're doing well in this backdrop, you're likely to continue to do well. And if you're not, then unless something radically shifts, you're probably going to continue to somewhat, certainly on a relative basis, struggle. So the beginning of this year, we made that change, moving away from growth to value, which so far has been a good call because I think we've avoided some of the risks that have come along with this tariff sell-off in a lot of the momentum names that were really growthy. And part of that call was, of course, because we hit a point where credit spreads were so ridiculously low and nobody was really pricing in any more macro risk. Now we're pricing a little macro risk. We think uncertainty is going to remain high this year, and that really is more about policy and just where we are in the business cycle. And so we think investors are going to continue to flock to stocks and companies that offer better visibility, more stability. I'd say investors are going to look for companies that are growing with certainty, perhaps dividend yield, which has certainly done well this year to date, largely because the market's gone down, and that can be an area where investors rotate into for defense. I think that can persist to some extent, even in a market that's moving sideways or ends up the year a little higher. So I think it's a year of embracing stability, income, value, but all of that with a quality wrapper.
Thank you, Michael. I've so been looking forward to having this conversation with you. I think it's such an important topic.
Thanks for tuning in to today's episode of What's Next for Markets. Please remember to check out the episode notes on our website, what'snextformarkets.com, for charts related to today's show.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.